Okay, let's talk about completing that accounting cycle today for our merchandising business. So we've done our adjusting entries, updating our inventory account to show the ending inventory. We've adjusted all the supplies, the prepaid anything, depreciation, etc. So now we're ready to then begin doing closing entries and preparing financial statements and journalizing all those things we've done in order to get to this point. So we're going to journalize adjusting entries from last time, and now we're going to journalize also closing entries to update all our Remember how simple this one was before? What did the income statement contain before? Revenue and operating expenses. Well, we wish, but no longer. It's still going to contain revenue, but as you know, for a merchandising business, revenue is now sales or some type of a sales account. And what impacts that gross sales? What are the two contra accounts? Sales return and allowance, sales R&A, and sales discount, which leaves us with something called net sales. So that's what our revenue is going to look like on the new income statement. Now, before we get to the expenses, however, we have a new section called, anyone remember? Good. Cost of goods sold. We need to determine the cost of all the goods that we're selling because that's part of the income statement. So that's going to come before your operating expenses or other expenses also. So cost of goods sold is a section that we're going to cover today, and we're going to then see it on the actual income statement. And again, it comes before expenses. Let's talk for a minute, though, about those operating expenses. Because before we simply listed them, operating expenses, and we just listed all expenses. They actually can be categorized. And so on a classified income statement, they are classified. So let's talk about which classification they will fall into. First of all, there's both selling and administrative expenses. So take a look at the list here of selling expenses. Those associated with the sale of the product. So those would include the salaries, the delivery, advertising, depreciation, all of those essential to the operation of this business that sells some kind of a product. Now, what would administrative expenses be? Okay, good. So other things would be the rent associated with operating that business, any kind of office salaries or the staff that's in the office. Those would be administrative expenses. Let's see, depreciation expense on the equipment that's in the office, not that's in maybe another part of the business, utilities and things like that. So those are all part of administrative expenses. But again, they all fall under the major caption operating expenses. Now, here's a brief breakdown, but we're going to see much more detail when we actually see the income statement. So take a look here. We have net sales, and how do you get to net sales again? Sales minus returns and allowance minus discount. That's how you arrive at net sales. So you have to show all of those components. You take that net sales and you subtract what's called cost of goods sold. You'll see abbreviated COGS or sometimes just CGS, cost of goods sold. And we're going to go through that in detail here in a little bit. But if you subtract the cost of the goods that we sold from your net sales, that gives you something called a gross profit. Not a net profit, but a gross profit, meaning a profit before expenses have been subtracted. So once we have gross profit, we just subtract operating expenses, and that leaves us with net income from operations. And then we have maybe some other expenses not directly related to the operation of the business, and or some other income not directly related to the operation of the business. Let's think about that. Maybe we have a staff room in the office that has a vending machine. Is that necessary for the operation of the business? No. Could there be expenses related to it? Yes. Could there be income? Possibly. Possibly you get a kickback on the sales from it. Again, it's going to be part of the business, but not part of the operations of the business. Therefore, it would be listed under something called other income. So we're going to separate that when we do it on the income statement. And we're going to do that again in a little bit. Now, here's a partial worksheet. It just shows that everything on the worksheet is there for you to find to put on the actual financial statement called the income statement. So take a look here. Here's the selling ones highlighted, and then, of course, the administrative ones. Okay, so everything is on the worksheet. Everything you need to create a financial statement. You just need to be able to determine where it is and to identify it as such. Now, other revenues, like I was just talking about, this rental income. Maybe you're renting out a room because you're not using it. Not necessary for the operation of the business, so it's going to go under other revenue. But still, it is revenue. Now, I want you to take a look at this partial worksheet here for a second, and we're going to take a look at the impact of everything that you see here on capital. This capital that's shown here is the beginning capital, correct? So what things will impact that beginning capital? What's going to make that go up or down? Good. Withdrawals are going to make it go down, and additional investments will make it go up. That one makes sense. What else will impact that capital? What's the big one that you're doing the business for? Profits or losses. So if you make a profit, that's going to result in an increase in that capital. And if you have a loss, that capital is going to go down for the next accounting cycle. So here's the net income. So the capital that we see on the worksheet is not the final capital for whatever period of time it's showing. That is the capital that we start with, and to that, the net income is going to impact it. So what do we show for capital? 10,500. So that capital will go up by the net income amount, correct? And it will go down by the withdrawal amount. And right now we can see what? What can you see there already? It's going to go down, net down, correct? Because withdrawals exceed net income. So you automatically know that that capital amount is going to go down. So again, a quick glance at the worksheet tells you how your income statement is going to look. Now, here's an example of a worksheet with a loss. And a loss has a negative impact on capital. Are there withdrawals? So that's a double whammy for that one. You're going to go down by the addition of the withdrawals and the net loss itself. So capital is going to go down when we actually create financial statements. Okay. We might as well show it to you at a glimpse here, and then we're going to go back and revisit this a lot today. This is your new and improved income statement. Now, I'm going to tell you a few things about it. First of all, you're going to have to know how to compile one. Not by looking at something else, by compiling it based on the order shown here. Now, do you see the 4 columns at the right? They're purposely there because it allows room for computations for various amounts, and I'll try to explain that to you here in a minute. But if you don't want to use them, it's not absolutely necessary as long as you can arrive at the right computations. For example, look at the very top. Do you see sales? And do you see the 2 contra accounts? Notice that sales is put all the way to the right because we're going to be subtracting things from that, so we want it to be way at the far end so we can subtract things. But what impacts that gross sales amounts? The 2 contra accounts. Because there's 2 of them, we put them in the previous column so we can add them up to see that total negative impact. And then there's a line, and the result of both sales discounts and return and allowance equals that 320 amount shown there. What do we do with that 320 amount? You subtract it from gross sales, and that's how we get that net sales amount. Now, the new section that we're going to find is going to be starting here with the caption, cost of goods sold. Cost of goods sold. Now, notice where it ends, right here. Cost of goods sold. This is the actual amount for cost of goods sold. All of this in between is how you compute it. How do you figure what the cost of goods sold is? So, let's go ahead and start at the beginning of it. So what do we start with for cost of goods sold? Whatever merchandise inventory we began with. And to that, we're going to add something called purchases, which is all the merchandise we're going to purchase during this period of time. But we can't just directly add it because we may have some deductions in that purchase amount, meaning the 2 contra accounts called purchases return and allowance and purchases discount. And those together add up to how much? How much do you see there? 260. So if you subtract the result of both of those together from the gross purchases of 2,000, what do you end up with? Do you see? Can you figure it? 1740, which is called net purchases. Purchases minus return and allowance minus discount equals net purchases. Same way we figured net sales, subtracting the 2 contra accounts. Now, that net purchases amount gets added to something called freight in, which is the shipping charges that are associated with the merchandise that we purchase. Will you always have freight in? No. Just like you will not always have purchases discount or purchases return and allowance. So if they don't have them, you don't have to include them. But if they do, this is the order they're put. Now, freight in, does that increase the cost of our purchases or decrease it? Increase it. So we need to add it to that net purchase amount. And that gives us something called, okay, so what are we adding to that cost of goods available for sale? Beginning merchandise plus freight in plus net purchases. All of those together equals the cost of the goods that we have available for sale. Makes sense. Think about it. The merchandise we began with plus the net purchases for that period, including any freight charges that we had associated with it, gives us the cost of the goods available for sale. Not the cost of goods sold, cost of goods available for sale. Did we sell all of it? Maybe, but if you have ending inventory, no. So you need to subtract that ending inventory from the goods available for sale to arrive at something called cost of goods sold. What did it cost us in order to sell the merchandise that we sold? So that cost of goods sold amount gets put way to the right underneath that net sales amount. And what do we do with it? Subtract it or add it? Subtract it. It's kind of like an expense, but it's the cost of the goods that we sold. So we take that cost of goods sold amount, subtract it from net sales, and we arrive at something called gross profit. Not net profit, but gross profit. So at this point, you're back to where we're used to being before we subtract operating expenses. So we're going to take that gross profit amount and leave it right there, and now we're going to list all our operating expenses. So notice the expenses are all listed there. We total them up, and then what do you do with the total expenses? Subtract them from the gross profit. Kind of like your gross pay. You have your deductions, you subtract it, and that ends up with your net pay. Same concept here. However, one tiny little addition or subtraction. The other income or other expenses gets put separately from operating expenses. Those expenses or income not associated with the operation of the business get added below. So we're going to have other income, if there is any, or other expenses. And after that's been added or subtracted, we then arrive at net income. So, I'm sure you're thinking, oh my, how am I going to do this? Well, we're going to do a lot of practice. Actually, next week we're going to do an activity to get you used to doing this. But besides understanding it, you do need to memorize it. You need to memorize the order in which things happen and how you determine different components. For example, if I was to give you a list of information on a worksheet and I said, tell me what net sales is, do you know how to determine net sales? Okay? If I were to ask you, what is the net cost of purchases? Could you tell me how to figure it based on the information given? Those are the types of questions I'm needing to have answered. Not only for the final, but we do have a concept quiz just on gross profit and cost of goods sold. So you won't need it for Tuesday, but you're going to need it for Thursday to make sure that this is clear in your mind, and we're going to go over it over and over again. Okay, what's the next financial statement after an income statement? Statement of owner's equity. Is that going to look different? Not too much. It's pretty much the same. What do you start with on the statement of owner's equity? No, not statement of owner's equity. Capital, beginning capital, good. And what affects that beginning capital? We just talked about it. Okay, additional investments, if there are any, and then either net income or net loss minus withdrawals. And that results in either an increase in capital or a decrease in capital, depending on what you have and how much the withdrawals are. So that's going to be pretty much the same as it was done before. And then that new capital amount, after we figure this, is the one that you're going to put on your balance sheet. You're not going to pull that amount that you see under capital on the worksheet, because that does not include the things that affect it, like income or loss or withdrawals. You're going to pull it directly from the statement of owner's equities ending capital amount. That's why we do it in this order. Income statement first, statement of owner's equity second, and then balance sheet last, because we need to compute the new capital amount from the statement of owner's equity. So again, here's an example. Beginning capital, there happens to be a loss for this one, and we have withdrawals. When there is a loss and withdrawals, what do you do with them both? You add them because they're both negatives, which results in a decrease in capital. And that then results in your new capital at the end of the accounting cycle or the end of the year. What will that ending capital become the next year? The beginning capital. So next year you'll start out with that new capital amount, which reflects what money you made and any withdrawals that you also took during that year. And look at the heading again. I know we've done this since day one, but the heading always includes the company name, the financial statement name, and for the purposes of the statement of owner's equity, the period of time for which it's being created. Not just a date, but the period of time. Another. Okay. The balance sheet. And I know this, again, is something we've covered, but it is new and improved also. No surprise. It's called a classified balance sheet, which means we're going to break it down a little bit more than we used to. We're not just going to have a category assets. We're going to have a category called current assets first. And first we need to define what are current assets. They are assets that can be converted within 1 year. So, for example, which things would fall under 1 year to be converted to cash? Cash itself would be one. What else? Would equipment? Probably not, because equipment usually is thought of as longer term. How about supplies? Yes, we usually use supplies within the year. How about accounts receivable? Yes, because we hope our customers are going to pay within a year. So all those things that should be converted within a year will be listed under current. Now, the next part of assets is called plant and equipment, often called property, plant, and equipment. And those are long-term assets, and they would include those that would usually be of value for longer than a year. So what would they include? What kind of things would they include? Vehicles, equipment, buildings, anything that's longer term in nature. Good one. The only things you can depreciate are those that last longer than a year. So anything listed under plant and equipment could possibly be depreciated also. Now, before we simply had a caption for liabilities, we're going to break this one down too into current liabilities. Based on what I told you current assets were, what do you think current liabilities are? Yeah, they're going to be paid within a year. So accounts payable usually is paid within a year. Otherwise, your creditors may come to visit. What else would there be? Current. What other liabilities do you remember that you're going to pay within a year? Good. Your tax liabilities. So the OESDI tax payable, the FIT payable, all of those, the government's going to want them within that year. So those are all going to be current liabilities. Wages payable, good one, because your employees aren't going to wait more than a year. So those are going to be current liabilities. Now, long-term liabilities would be what? No. What would they be? 'Cause
Mortgages.
Good. Mortgages. Unfortunately, those mortgages last a few years. So that's going to be a long-term portion. However, even though mortgage is a long-term liability, the current portion, or the part that we pay within the year, will be reflected under a current. So we're going to subtract the current portion always from the long term. And we'll be doing some of that, so you'll get to practice doing that. But again, mortgage payable, it's a long-term debt. So therefore, it is considered a long-term liability. Now, take a look at this partial worksheet again. Notice you'll see current assets usually listed first. When you set the chart of accounts, usually you look at those liquid assets and list them first because they're the ones most frequently used. And see the things we have under it. Cash, petty cash, supplies, merchandise inventory, prepaid insurance, because usually we don't pay for that for more than a year in advance. And then longer term, it's going to be store equipment, automobile, things like that. And your current liabilities, again, are your taxes payable, your accounts payable, and one we didn't talk about a minute ago, but unearned rent. Remember, rent that's paid for in advance? So that liability will be taken care of usually within the year. They don't usually pay for more than a year in advance. And then mortgage payable will be long-term, except for the current portion or the amount paid within that year. And then salaries payable also goes under current because it's going to be paid during the year. Sure. We'll leave it up there for a second. And again, look at the note at the bottom. $3,000 of mortgage payable is due within the year. So $3,000 of that would be a current one, not a long-term one.
What is unearned rent? Is that like as if it was like a rental company?
Unearned rent is maybe you were collecting rent on a part of your, maybe a storage room or something, and you collected in advance. Well, because you collected in advance for a period of time, they may opt to not do it any longer, in which case you'd have to give it back. So until the months go by, you've not earned that amount. It's not revenue until you've earned it. And we can bring this back up too if you don't have it all. So let's take a look at actually what the balance sheet may look like. And again, the format of it can be different, but this is the order in which it's shown. Always listing assets first. See our current ones listed, then you get the total for those current assets. To that, we're going to list the long-term or property, plant, and equipment. And notice what's in there for store equipment. Yeah, remember what that is? Accumulated depreciation? It's a contra account. Does it impact that asset? Yes. So we're listing it here because it reduces the net value of store equipment. You would take the amount or value in store equipment, subtract the contra account for accumulated depreciation, and the amount over to the side of that accumulated depreciation shows the net amount for store equipment. The net amount for store equipment. Same thing is true with automobile. So again, make sure you're including contra asset accounts on your balance sheet. Before, some of you tried to put them under liabilities. They're not liabilities. They're contra asset accounts. So the total of both your current and long-term assets will be your total asset amount. Now, let's look at the remainder of the balance sheet. Current liabilities separate from long-term liabilities. And again, we're going to add them up separately and then add them together. But in addition to that, we have to plug in the capital amount. And where do we get that capital amount? Statement of owner's equity. After we complete that, we have the new improved capital amount. And that's what gets put on this balance sheet. So if we add all the liabilities together along with the capital, it should agree with our total assets. And if it doesn't, something is wrong. Someplace in the accounting cycle, you've missed something. But again, the balance sheet is meant to keep that accounting equation in balance. Assets equal liability plus owner's equity. All right. We're going to go backwards a little bit here for a minute. Remember last time we did adjusting entries or adjustments on the worksheet? And we updated merchandise inventory, we updated supplies, depreciation. Well, those have to be journalized just like we did before for a service business. So when you go to the journal to journalize those adjustments, what do you put at the top? Adjusting entries. You literally write that in your journal so that anyone looking at your records can see these are now adjusting entries. So once the worksheet's been completed, you're going to journalize those adjusting entries. And here's just a couple of examples. Remember, we're closing out the beginning inventory and then putting in the new ending inventory. So those are called adjusting entries. And see, here is the caption here at the top of it, adjusting entries. And again, another one, insurance expense, prepaid insurance. It's listed in the adjustment columns, but we need to journalize all of these. If we only put them on the worksheet, our financial records aren't updated, because that's just an informal working paper. We have to journalize and then consequently post in order to update all our records. So I'm going to go through some of these quickly here. Depreciation expense and accumulated depreciation, wages expense, wages payable. All right, here's the new thing for journalizing. Once adjusting entries have been journalized and posted, the next step, which is just the same as last time, is closing entries. But the procedure for closing entries is much different. So what's the first thing we closed before for a service business when we did closing entries? Okay, whatever revenue account it was. Well, that is similar now, but a little bit more. Instead, we're going to do this. We're going to look at the worksheet, and we're going to look at the credit column, and we're going to do what's called compound entry. We're going to close out all credit balance accounts on the income statement columns, except for income summary. We're not going to do anything with income summary right now. So we're closing out all credit balance accounts on the income statement. Now, what are we going to close them to? Income summary, that temporary account. So to close out those credit balance accounts, what would you have to do to them? Debit them. So here's an example. Hardware sales debited to close it out or zero it out. Purchases discount. Purchases return and allowance. And then the total of all of those gets put into income summary as a credit. Okay, that part's similar, it's just more accounts. All of those together are put in one lump sum in an income summary. Yep. So can you guess what the next part is going to be? If we closed out all the credit balance accounts on the income statement, what do you think we're going to close out now? Yep. We're going to look at all the the debit balance accounts here on the income statement of the worksheet. And we're going to close those out in one transaction. So look at the ones that includes sales return and allowance, sales discount, purchases, wages expense, and all the other expenses. In order to close those debit balance accounts, what must we do to them? Credit them. So here's what it'll look like. We're going to credit all of those debit balance accounts, thereby zeroing them out. And the total of all of them together is my debit to income summary. So I had a credit from the other closing, and now I'm going to have a debit, just like we used to have, but with lesser accounts. So far it's pretty similar, just more accounts. It's the next step that is a little bit different. Now, the next step used to be we take the balance and income summary from closing out the revenue and expenses and close it out into capital, correct? Well, we're still going to do that, but look at income summary. It has more than just those two amounts in it. Why? Good. Because we also use income summary to adjust merchandise inventory. Remember, it's that beginning and ending inventory amounts? So those are also in there. So we have to add up both sides of income summary to determine what's the balance before we can close it. We have to add up both sides of income summary, both the debit and the credit. Find the difference, and that'll either be a debit or credit balance. And that's the amount that you use to close income summary, is the actual balance in it. And there should be 4 entries. One from the beginning merchandise inventory closing it, one from putting in the ending, and then one from closing out the credit balance accounts and one from closing out the debit. So once we determine this balance of 1984 in income summary, we're then ready to journalize it. So if it had a 1984 credit in income summary, to close that out, we'd have to debit income summary. And we then would credit capital. And if we're crediting capital, is capital going up or down? Up. So did we make money? Yes.
Wouldn't you have closing entries on there somewhere?
Remember, it's at the beginning of it. This is the third one down, so you don't do them before each one, just before all of them. And what's the last step in closing entries? And this is the same as before. Yeah. So how do you close out withdrawals? Credit it. So what are you going to debit? Capital. If you're debiting capital, is capital going up or down? Down. All makes sense. So we do J-spool capital as a debit and J-spool withdrawals as a credit. And once we journalized all of these closing entries, our capital account in the general ledger is now up to date. So we're ready to start the new year or the new accounting period. And once we do all of that, we have one more thing to do to check our accuracy of our records. And this is something we did before, a post-closing trial balance. What is on a post-closing trial balance? Yes, you can. It's after adjusting and closing entries, so you're going to see no temporary accounts, only permanent. All the balances and all your permanent accounts. if they have balances. You don't have to list them if they don't. You're just going to list them in order from assets through capital and their new updated balances, and the debits should equal the credits as always. So on your post-closing trial balance, it's just making sure that your permanent accounts have accurate balances and that accounting equation remains in balance. So it's the last check before you start a new period or start a new year. The post-closing trial balance. So what goes on the heading of a post-closing trial balance? Company name, post-closing trial balance, and just the date. Because this is as of a specific time. Not for a specific time, but after a specific time has transpired. So it's as of a specific date.